Hello, chart watchers and Decision Point faithful. Welcome to this Friday, March 2nd, 2020 Decision Point show with your hosts, Carl and Aaron Swenlin. For those of you joining us for the first time today, we welcome you to the show and we hope to see you back every Monday at 5 p.m. Eastern Time. All right, well, we have a lot to cover today, Dad. How are you doing?
Confused. No. We'll try to get unconfused.
Yes, we'll hopefully be able to unconfuse some of our viewers with today's agenda. So we're going to talk about this roller coaster that we are currently on, and we wanted to talk to you a little bit about bear market rules. And Dad, you came up with these years and years ago, and I think they definitely have stood the test of time. And it would probably be a great idea to remind our viewers about that. So we're going to cover those. We're going to look at some of those warning signs that we did have before this drop. We did, both of us, write some articles in the StockCharts Decision Point blog. I know you had one. It was We Were Warned. And then I did mine, We Were Warned Part 2, where I basically reposted the paid Decision Point alert for that day, just because things were, well, it was kind of a crazy day. So we'll look at some of those warning signs, but if you want to get more information, highly recommend you go over to the Decision Point blog. You'll find it on our website, the links to those free articles just from the blogs and links section. So anyway, we'll talk about that. I wanted to just briefly discuss some of the sector rotation that we're seeing and some of the things we should look for and be concerned about. Charter subscriptions. Our subscription rates are going to be going up on March 7th, almost a week from today. So we recommend that if you have thought about subscribing to Decision Point, that you might want to do it this week. So we'll talk a little bit more about that later. And then our bonus, everybody, the question box is open on the live broadcast. So go ahead and put your questions in. And if we do have some time at the end, we'll try and save some. We will talk a little bit more about your questions. So go for it. Let's start off though. I think it would be good just to go over these rules even before we look at what's going on today, if that's okay.
Yeah, we should make it clear. Well, at least I personally believe we are in a bear market. Mm-hmm. And I don't know if you've reached that conclusion. No, but yeah, I think that we're in a bear market, and certainly, well, it's just.
These are great, you know.
That's my guess. If you know, when it hits 20% down, then it's official. But right now, it's a guess.
Yeah, absolutely. But, you know, given the environment of fear and selling and all of that, I think that it's still really appropriate to look at these rules just to give you some guidelines as we continue through this. And, you know, one of the big ones that I have been that my readers have been especially asking me questions about are these oversold conditions, and is this now the bottom because we really have hit some great oversold conditions? Well, the answer would be maybe. When we're in a bear market situation or configuration, you have to think of oversold conditions as a little shaky. I liked your conclusion, Dad, thin ice. You know, you might be able to get a bounce off there, and we're not going to go down every single day, but we have to be aware that even though we're seeing oversold conditions, a lot of times it's not enough. And that, of course, buying into a bear market or bear market conditions is dangerous. I know a lot of people are doing that today. We can expect bearish conclusions, really, from our chart patterns. Just from the way we read our charts, we should always be leaning toward a bearish conclusion. And just to throw it in there, overbought conditions, we're not there for sure. But usually when you do hit that in a bear market configuration, you have to expect that new down leg. So I think those are good to think about as we go through our charts. I'm going to post the Decision Point scoreboards in the DP alert today for our paid subscribers, but you can find them on the homepage on your dashboard on StockCharts, you can make one of the tiles be one of the DP scoreboards. But I wanted to just point out that this last week, we continued to lose buy signals. The NASDAQ 100 so far has been able to prevent a negative 20, 50-day EMA crossover. So we're still looking at a buy signal there. But I don't know how much longer that is going to last. Certainly, if we can continue this rally we had today, that would be great. But as a consequence of what's been going on, we did lose some more buy signals in the sectors. We got a neutral signal on the comm services sector, XLC. So that is something that I will probably be leading with in today's DecisionPoint alert.
This
Yes.
This is a little behind.
Oh.
The MA3 that are still on buy is real estate, technology, and utilities. The rest are neutral.
So this area right here is the only one that is buy now.
The other ones are neutral, except of course energy.
Wow. Okay. Yeah, well, it is a consequence. That's one of the reasons I wanted to look at sector rotation, just to see, where are those pockets of strength.
Okay.
So yeah, if we're looking at the bottom of this, it is interesting that XLK is still hanging in there, but more than likely it's just because of the advances being much higher than the other sectors. It's just managing to prevent those signals. So let's go ahead though and look at some charts. Would you like to take the screen and start talking about what you're seeing, or do you want me to pull up some?
Okay, I can do that.
All righty. Yeah, it's not been fun, that's for sure. Today seemed a lot more upbeat, and I have to say, I don't know, the news programs certainly were. They were almost giddy.
Right. Let me find my way here.
Mm-hmm.
Okay. Let's just start out with a close-up of the market. Notice right here on Friday, we got a 2050 downside crossover, which is all we also call a trend model cells neutral signal in this case. And also it's a silver cross to go along with the golden cross.
There you go.
Okay. But we actually hit the bottom on Friday. And even though the market closed down, this was a reversal day. And I had said in the weekly wrap that it looked likely that the bounce, we'd get a continuation of the bounce on Monday. Magnitude, had no idea, and I don't know of any way to tell. But in terms of the size of the day, which is the largest point gain in the Dow ever. I just think it's silly though, because the points encompasses the 29 bear market many times over. So it's really a percentage move. Mm-hmm. And it was over 5%, which is interesting. And the S&P 500 was up 4.22%. So there's a lot of weight of Apple in this picture. Notice there was a pullback on volume. Let me go to, okay, this is one I was going to feature. Quite a bit of stuff going on here that I wanted to talk about. But the main thing in terms of what happened today, well, we were oversold. You can see stocks above their 20 EMA was close to zero. Same with stocks close, above their 50. That was close to zero. And we had a very deep reading on the stocks above their 200. That was 24%. This was the last cyclical bear market we had. And you can see down here, that was right about 5%. So we still have more to go before it gets really, really oversold. But this is pretty deep. But when you get this oversold on these shorter term indicators, it's certainly a good chance you're going to get a bounce, because these don't dribble along the bottom. That's not, they can, but they generally don't. They usually reverse. So that would have been the clue that we have that we were going to get a bounce. And of course, the action on Friday was also a good clue.
Mm-hmm.
Before I move on, I wanted to say, we were talking about last week, we wrote about how we had warning of the move downward that we had from the all-time high. And again, no clue as to the magnitude it might be, but we have, losing strength as the market's going higher. The number of stocks above the percentage of stocks above their 20 is moving lower. Same with the 50, same with the 200. And you don't often get, as often anyway as the other two, the divergences on this 200, because it takes a lot to move that. But here we had one here, and you see it right about this top here. And these divergences, it just be alert. You're probably going to get some significant down move. In this case, we didn't get that kind of a warning in any of the three cases. The other clue we have is the steepness of the advance. This was a parabolic, so we knew that was going to crack at some point. That's a warning. Again, this was a very steep advance right here. The only advance steeper would have been this tail end of the parabolic. When you see steep advances, that's, watch out. They can't sustain.
Exactly. Those vertical moves that we were experiencing at the end there too are just, it just can't keep doing that.
Right.
It's not sustainable.
On our climax chart, we look for, we're not going to see any climaxing on the new highs, new lows, because we just came off of a down thrust of new lows. And of course, on an up move, it takes a while for the new highs to start to catch up. But we did get the breadth, volume, spikes, and that is a climactic move. And I have to say, at this point, we'd have to consider it to be a initiation climax. Mm-hmm. But consider my outlook, I don't think it's going to initiate anything that's going to last very long.
Yeah, it's always tricky, when we get those climactic readings, because that's when I sit back and is this an exhaustion? Is this an initiation? And really my main rule of thumb is, what was the trend right before it? And, in this case, obviously the trend was very, vertically down. And again, vertical moves, I think, in either direction aren't really sustainable.
Here are our short-term indicators. The ones that have updated, these two, the STOB and V, have turned up. So, and that they are very oversold. They got very oversold. So there's another clue that bounce is probably coming. The percent above 20 EMA and percent PMO rising don't update until much later in the process. So we don't get a look out of it this time of the day.
But I will have them in the DP alert this afternoon for our paid subscribers.
Exactly. And they'll be on our chart lists on the DecisionPoint.com website.
Mm-hmm.
Intermediate term, got a little deceleration today, but they're still headed down. And
they're not completely oversold.
No, this is oversold on these. So that's one of the things I covered in the weekly recap was two possibilities. We're going to either have, a pullback, and that'll, and it'll take some time to work through it, but then a retest and then continue higher, or it's going to continue into a bear market. Those are the choices I have right now. Obviously, there are other things that could happen, but those are my favorite outcomes that to look for.
Yeah. So I mean, we're seeing a little bit of recovery in the short-term indicators, but yeah, intermediate term, it'll probably take a little while to turn that bus around. What do you think?
Yes.
Okay.
Gold has really been flaky. It's hard to figure it out. But anyway, I thought we were on our way, and by golly, as a flight to safety, people just didn't get on that bus, and it has held. So we've still got a good rising trend in place, but keeping an eye on that.
Yep. I know that was something that I've been talking about to others, my brethren. And yeah, just talking about the fact that, it was really interesting to see with this heavy decline that gold didn't just, have a great day.
Yeah, it's really strange. And then, of course, this massive advance on stocks, and gold advanced. So
yeah, it's been strange because it's been going the same direction as the dollar, which is very unusual.
I covered this in my lead article on Friday, but people are wondering, well, are there any bargains out there? Is the market undervalued? No, the answer is no. The market has been extremely overvalued. This is if it had a PE of 20, it would be here, and it's been way above that. So it's just PE of 20. Why is that important? Well, that would mean your net profit is 5%. Undervalued net profit of 10%. So anyway, anytime you're getting above that line, your net profit's going down. Now maybe there's growth involved, et cetera, et cetera. But as a long-term solid indicator, there is no bargain out there. I mean, yeah, okay. There are not likely to be any bargain. Certainly the S&P 500 is not selling at a bargain price. If we haven't been undervalued since 1984, and here we got roughly fair value, I would say. But at this level, no, you're not going to find a bargain. You're just buying, at a less overvalued point.
Right.
And did you want me to go through the? Wait, I had. Oh, here was a troublemaker today for the
yes.
Apple up almost up over 9%, and well, there you go.
Yeah, and that's honestly one of the warning signs at the beginning of April that I was, flagging was the fact that, yeah, we were making new all-time highs and all of that, but then we were seeing those deterioration in those breadth indicators. But I also noticed, those days we were making new all-time highs, almost every time it was being led by these big guys. The cap-weighted, index was really being, it would swing around because of that. And one of the things that I looked at was the equal weight, just to get a feel for, how much, are they really affecting things? And it was very eye-opening, because it was clear, looking at an equal versus a cap weighted, that clearly the big guys were carrying the numbers.
And I was reflecting on the big down move at the time, that so many people out there say that they're long-term investors, but it's so easy in the heat of the moment for them to log on, and a few clicks, and they're out of their position. They can dump it that fast. So it's a different world than when I started out. You had to call the broker, tell them what to sell and or buy, and it moves really fast.
Yeah, it's very interesting. We've shown Apple charts too, and all of their parabolics and the huge declines that happen a lot of times after.
We have a set of the sector charts, and did you want to go through those?
You know what? I'm gonna go ahead and do the ones that you wanted to look at in our format, and then I wanted to go look at just the candle glance and just see overall what the sectors look like. How the damage has been done. But I know this is an area of strength that we've talked about. Real estate has been an area of strength, and healthcare to some degree.
Yeah, today the three leaders were utilities, tech, and real estate.
Right. And having tech in there, I think, is a positive, because it is one of the more aggressive sectors, but at the same time, it seems to be just a sector everybody goes to when you see those, when you want those to take advantage of these bounces, those tech companies. Well, we just looked at Apple, and Tesla's another one, but we're seeing utilities, consumer staples, real estate. They're still really leading the market. And today, the utilities and consumer staples took control. And in a bear market, those are the things that confirm what we're talking about. The rallies in a bear market come off the backs of those defensive sectors, not the aggressive ones. And when you see that rotation, if we start seeing it back into those aggressive sectors, then I could feel a lot better about not looking toward a bear.
Right. And notice that the yield on the utility sector is 2.9%. And each sector runs into the same problem of showing weakness in the indicators, although it did not happen here with utilities. The only clue, again, would have been but certainly one clue would have been this sharp up move. Well, the rest of the market was having a little bit of problem, but still heading towards the top. But this was a very sharp up move, and you just kind of
sure. And in a defensive
you don't bail,
sector,
but it's just that you so you wanted to see discretionary.
Yeah, XLC, because we just got that change today, right?
Right.
And then, yeah, XLP is the other one of the leadership areas, if you want to call it that.
Right. You see, it did get some weakness showing on the indicators as it was going higher there. And notice that it wasn't moving up as aggressively, so you could see internals that were not doing so well.
Right.
Yeah. Did you?
Yep. XLC, let's take a peek at that one, because we did just get that change. And then honestly, I wouldn't mind looking at discretionary as well, because with the virus, that's one of the sectors that some of the fear factor is in, with restaurants and that sort of thing.
Yeah, it just did a silver cross on the knot. This is the opposite. You have the golden cross and and death cross on the longer term. We have the silver cross, and I guess we could call it the flu cross.
There you go.
On this.
Yeah. I mean, I do have to say a lot of this was certainly impacted by the virus, maybe the veracity of it. But as we've been saying, technically, this was really long overdue.
Yeah, that's something I wanted to talk about too. The coronavirus is, I'm just astounded the way the focus is on it. I mean, it seems like I haven't figured out why it's any different than the flu.
Right.
Except everybody's just totally focused on it. I don't know how many flu deaths have we had this year, this season.
Right.
20,
in comparison, true.
I don't know, but it's a lot. And whereas everybody's focused on this, well, it's a stampede. Don't stand in front of a stampede. And this, people are concerned about it. And that's one of the reasons I think we've broken down into a bear market and we're going to stay there. We're not going to get faked out.
Right.
Because of the coronavirus. A magic wand could be waved, but and change that situation. But right now, it's going to drag on.
Yep. And I mean, just intuitively, I'll be watching, of course, the healthcare, medical supplies. I've already been writing about those in my diamonds reports, for watch lists. This point, I'm not exposing myself to this. Maybe those short-term traders out there can handle it, but certainly not my cup of tea. But maybe those will be the areas that we do finally see some movement. If the main thing is, though, what they keep telling us, Dad, is that this virus, these vaccines, and all this may take months, to actually have them available. And so while you might see a bump in these stocks, it might take some time until we actually see something come out.
Right. It's just, we're either going to get an antivirus, but that'll take a long time. That'll take months. And if not, the other way it could resolve is just people stop worrying about it.
Right. All right, so we only have a little bit more time. We didn't have any questions. I think people were just really interested in what you had to say. But here is that sector summary. I like to pull it up and look at the candle glance just because for me, it gives me a really good sense. Just looking at a simple, OHLC chart. These are 6 months with the PMO on them, the 20, 50, and 200-day EMAs. And I've been watching and again talking about utilities as an area and real estate, mainly just because we still have not seen that silver cross or the anti-silver cross with the tarnished cross where we have the 20 crossing below the 50. So there's still a few areas in technology. Like I said, the only reason I think we haven't gotten that neutral is just because it tends to travel quickly to the upside. There's more work it has to do to get that 20 all the way down there. But I think it's just interesting to sort of see in general where we're looking at all of these. So
it's we're out of time. I better be quiet.
Oh, you can make your last quick thought.
Quick thought is it takes a long time when you have a steep advance, it takes a long time for the 20 to get down across the 50.
Absolutely.
So
all right.
The cheaper it is.
Yep. All right. Great to have everybody with us. Let me remind you that we are on Mondays live at 5 p.m. Eastern. We do hope you'll come back and join us. Hang in there. Keep an eye out. We are losing our charter rates, so go do it.